Listen guys, nothing against SCHD at all, but the 10 dividend stocks we're talking about in this video absolutely dominate and put SCHD's returns to complete shame. While SCHD has generated an impressive annualized return of just over 13% over the last 10 years, it still doesn't hold a candle to a portfolio of these 10 stocks who together brought in nearly double that return in the same time period. Now we're going to go through each of these stocks and see how they all stack up against the coveted holy grail of dividend ETFs, but before we get to that, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch so we both continue to grow our portfolios and collect that cash flow. Now this first company that absolutely dominates SCHD is SnapOn, and in case you're not familiar with this company, SnapOn is a leading global manufacturer and distributor of high quality, innovative tools, equipment, and software for professional users in various industries like the automotive industry, manufacturing, and they even supply tools for the military. As far as the dividend goes, they've been paying it out to shareholders without interruption since 1939, which is a very impressive feat, and the dividend stats themselves are also pretty astonishing. Starting here with the dividend yield, this is actually pretty average, 2.75%, but that payout ratio is nice and low, under 35%, with a lot of runway to continue growing that dividend, which they most certainly have at a very aggressive rate. Their 5-year growth rate is about 15%, and they've been growing this dividend for the last 13 straight years. Now, as far as how it stacks up against SCHD, we can see here in the last year, it's absolutely dominating with a return of 16.3% compared to SCHD's minus 3.35%. And then zooming out across the last 5 years, SnapOn has outperformed SCHD on a total return basis by nearly 10%. And then zooming out once more across the last 10 years, SnapOn is crushing SCHD by almost exactly 50%. Anyway, guys, moving on to the second company, this one is Starbucks, who started in 1971 and today operates over 35,000 stores across the world. And fun fact, Starbucks is actually my largest position and currently makes up just about 9% of my portfolio's total allocation. But anyway, taking a look at the dividend stats, this forward yield is a bit lower than what we saw with SnapOn and certainly lower than SCHD's, about 2%, but that 5-year growth rate is nice and high, 13.15%, and Starbucks has been growing this dividend for the last 12 straight years. Now taking a look at the total return, guys, it's not even close. In the last year, Starbucks is up 35%, clearly crushing SCHD. And then zooming out across the last 5 years, it looks like Starbucks has about a 20% edge, and then the 10-year return is pretty impressive here. Starbucks has outperformed SCHD by over 120%. Anyway, moving on to the third company, this one is Best Buy, and admittedly, I was surprised to find that Best Buy had outperformed SCHD because in my opinion, the share price performance really hasn't been that notable for this company, at least as of late. I mean, in the last year, Best Buy is down 20%, and if we zoom out across the last 5 years, it's up less than 5%, so this really isn't a great share price return. But here's the kicker, guys. If we zoom out across the last 10 years, this is where most of the returns have come from. They're up almost 230%. And then looking at it on a total return basis, instead of just the share price performance, Best Buy is outperforming SCHD across the last 10 years by over 125%. Not too shabby, Best Buy. And Best Buy is looking to be a triple threat in the dividend department. Look how high that forward yield is, just under 5%. And that 5-year growth rate is looking phenomenal. This is the highest we've seen all day, 19.35%, crushing it. And they have a pretty decent dividend growth history as well, 12 consecutive years. And now moving on to the fourth company, guys, this is Packaging Corporation of America, PKG, which has been around since 1867 and is about as boring of a company as you can find. Essentially, they make things that you use to pack and protect items that are shipped, like cardboard boxes, and they also make a special kind of paper called container board that's used to make those boxes. And the dividend stats on this company are looking great. They have a nice 3.5% yield with a 5-year growth rate that's once again in the double digits, nice and high, 14.69%, and they also have a dozen years of dividend growth. And I'll tell you what, guys, for as boring of a company as PKG is, their returns are most definitely the opposite of that. Now, in the last year, PKG is actually seeing more of a drawdown than SCHD, down 5.4% compared to SCHD's 3.3%. And even zooming out across the last 5 years, the same is true. They are underperforming SCHD by about 30%. But here's where it gets interesting. Across the last 10 years, PKG is blowing SCHD out of the water with a 344.5% return, which is about 133% higher than what we're seeing with SCHD. But anyway, guys, moving on, the next stock is Abbvie, which is a pharmaceutical company that spun off from Abbott Laboratories back in 2013 and is probably most known for making drugs like Humira, Skyrizi, and Rinvoq. And once again, guys, we've got another high growth dividend stock on our hands, and the yield's not too shabby either, about 3.7%, and that 5-year growth rate is sitting at about 17%. right where we like it. And Abbvie has been growing their dividend for the last 9 years. So essentially, they've been growing it since they spun off from Abbott Laboratories. And now looking at the returns here, in the last year, Abbvie is up 1%, so it is beating SCHD by just a few percentage points. And in the last 5 years, it's doing quite well compared to SCHD. It's up about 122% compared to SCHD's 76.5%. And wow, look at this, guys. Across the last 10 years, Abbvie is up over 471%, which is over twice the return that you would have got from investing in SCHD. That's pretty unbelievable. But anyway, moving on to stock number 6. This one is Lowe's, who, along with Home Depot, is one of the largest home improvement retailers here in the United States. And this is one of my favorite high growth dividend stocks. Taking a quick look at their stats, the yield is on the lower end, but that is okay, guys, because that 5-year growth rate more than makes up for it. Over 20%, which is the first time we've seen this today. And Lowe's is a dividend king with 59 consecutive years of dividend growth. That's hard to beat. And as far as the returns go, Lowe's is seeing pretty similar returns in the last year as what we saw with Abbvie. They're only beating SCHD by a few percentage points. But then zooming out across the last 5 years, Lowe's has generated more than double the returns of SCHD with a gain of 156.5%. And then this is just unreal, guys. Across the last 10 years, Lowe's is up 531%, which is more than 300% higher than the return you would have gotten from investing in SCHD. Crazy. But anyway, this brings us to the 7th stock of the day. We're talking about Rollins, which is one of the largest pest control companies in the world, and they operate in over 70 different countries. And as far as the dividend stats go, I think we've seen better, but still, this isn't terrible. The yield's pretty low, 1.34%, but that 5-year growth rate is still pretty nice, 16.4%. And they only have a 2-year dividend growth history, but if we go up over here to the dividend history page, we can see that they've been making consecutive payments for the last 18 years. So there is still some consistency there. And I'll tell you guys what, I've been dying to add Rollins to my portfolio for some time now, at least a handful of months, but it just keeps going up in share price. Taking a look at the total returns, in the last year, Rollins is up almost 11%, which is definitely beating SCHD. And then zooming out across the last 5 years, SCHD kind of catches up to Rollins, and it's only trailing it by about 4%. But here, guys, in the last 10 years, this spread is unbelievable. Once again, Rollins is beating SCHD by over 300%. In this instance, about 345%. So that's quite a big difference. But anyway, moving on to stock number 8, this is United Health Group, who serves millions of customers across the United States and in over 150 countries around the world. So UNH is everywhere, and they offer a wide range of healthcare services, including medical, dental, and vision insurance, as well as pharmacy benefit management and health and wellness programs. Now, the dividend stats here are looking pretty dang healthy. The yield's on the lower end, only 1.3%, but that payout ratio is super low with, once again, a lot of runway to continue growing this dividend, which they certainly have. That 5-year growth rate is sitting nice and high, just above 17%, and they have a 13-year dividend growth streak, which is not too bad at all. Now, as far as the returns go, both SCHD and UNH are in the red here, but UNH is still seeing less of a drawdown. And then here in the last 5 years, UNH is almost doubling the returns of SCHD. And then this is crazy, guys. Across the last 10 years, UNH has generated a 912, almost 913% return, which means it's beating SCHD in this time period by about 700 freaking percent. Can you believe that? And now this brings us to the second to last stock of the day. We're talking about Insperity, which is one of the largest human resources companies in the world, and their services allow businesses to outsource many of their administrative tasks like payroll and other HR stuff, which frees up their time to focus on actually growing the business. And this so far is the highest dividend growth rate we've seen all day. That yield's pretty low, 1.7%, but look at that, guys. A 5-year growth rate of 26.19%. Can you believe that? And they have a dozen-year dividend growth history, which is pretty dang solid. Now, looking at the returns, Insperity is just blowing SCHD out of the water. Insperity's up about 25% in the last year, so they've done really well. And across the last 5 years, this spread isn't as wide, but still Insperity is beating SCHD by about 11% or 10.5% there. And this is going to blow your mind, guys. Across the last 10 years, Insperity is bringing in our first 4-figure return of the day, up 1,070%, which basically means you would have 5x'd your return investing in this company compared to if you invested in SCHD across the last 10 years. But anyway, this brings us to the last stock of the day. We're talking about Broadcom, which is a semiconductor company that works a lot in the communication space, and some of their customers include companies like Apple, HP, IBM, Samsung, and Sony. And their dividend stats are super sweet, guys. They have a forward yield sitting at about 3%, not too shabby, and that 5-year growth rate is phenomenal, 25.7%, and they've been growing that bad boy for the last 11 straight years. Now buckle up, guys, because this company's returns are absolutely going to blow your mind compared to SCHD. I didn't even think this was possible. In the last year, things are looking pretty normal. Broadcom's up about 10%. Okay, that's pretty nice. And here, even just across the last 5 years, Broadcom is up over 200%, which is more than double the return you would have gotten from SCHD. But guys, this is where it gets just completely mind-blowing. Across the last 10 years, Broadcom is up almost 2,500%, which means they have more than 10x the return of SCHD. This one company. I don't even know what to say to that. That's just absolutely mind-blowing. But anyway, guys, those are all of the 10 SCHD crushing dividend stocks. And if we put all 10 of these stocks into a portfolio, we can see that across this entire portfolio, we'd be averaging a 2.61% dividend yield, and the 5-year dividend growth rate of this portfolio would be about 18.5%, which is really nice. And across all 10 stocks in this portfolio, on average, you'd be looking at a 16-year dividend growth history, which I think is pretty great. Now, if you were to go back in time 10 years ago in 2013 and invest $1,000 into this portfolio, and then from that point on invest $100 every single week until today, you would have a final balance of $141,756, which is about $50,000 more than if you were to have just invested in SCHD. And once again, just to reiterate, this portfolio would have yielded a 23.8% annualized return across this time period compared to SCHD's 13.11%. But now switching gears, let's say that instead of going back in time, you just decided to start investing in this portfolio today. What would those returns look like 20 or 30 years down the road from now? And to figure this out, we're going to use the marketbeat.com dividend calculator, and it's going to be a very similar setup. An initial investment of $1,000 with $100 contributed every single week. We've got our starting yield of 2.6% here, and although our 5-year CAGR on the portfolio was somewhere over 18%, we're going to be a little bit more conservative here and say the annual dividend growth rate is going to be 13%. And we're going to see what this looks like across the next 30 years. Now, before we look at the 30-year results, let's stop here at 20 years, where you'd have about $21,000 of annual dividend income coming in just in that 20th year. Now, at this time, this portfolio would be valued at about $382,000, so that's pretty nice. But this is the really cool thing about that dividend snowball and having that exponential dividend growth, because once we go 10 more years down the road by that 30th year, we'll notice that the dividend income will be a lot higher than you'd think, and the value of your portfolio will be unrecognizable. It's crazy. So just in that 30th year, you'd go from about $21,000 of annual dividend income to $141,000. Unbelievable. And your portfolio value would go from about $382,000 to $1.6 million. Can you believe it? I think it's really exciting to play with these tools, and seeing those numbers just really gets me stoked about the future and just makes me want to invest more. And if this gets you pumped too, and if you're looking for some more great ways to invest for massive dividends, then check out this next video right over here. Here we'll be looking at 3 different portfolios, one that's an ETF portfolio, another one that's comprised solely of individual stocks, and a third one that takes a hybrid approach between the two. And we'll see which one would generate the most dividend income and would leave you with the largest portfolio. So click right over here to check that out, and I'll see you in the next one.